it. Let's do it.
Let's go.
Awesome. How many people do we have logged in right now? Is there 100 right now? Are we at the cap?
100, yeah.
We are.
Oh, awesome. Love it.
So, can we have more? Can we get leeway for more?
You know, we're going to let it go with 100 right now. We had 250 people register. We're going to record it, and then we're going to share it into our Facebook group. But because we're going to do this every month, we want to make sure that people stay pretty active. We might open it up to a larger group later, but we want to keep it to 100 max this time.
Okay.
With that being said, thank everyone very much for attending our first Multifamily Masters live online Zoom meetup. We're going to do this every month, typically the third Monday of the month, 9 p.m. Eastern, 6 p.m. Pacific. That gives everybody kind of a after work. You should be a little bit flexible. Hopefully everybody can make it, but if you can't, it will be recorded and we probably will be sharing it with the public. With that being said, what is Multifamily Masters? We're in the process of creating the world's largest multifamily cash flowing platform. Right now, in the last 4 months or so, we have about 60 meetup chapters across the world. We just launched our first one in Hong Kong, and we're in several markets across the US. Every week, we're getting more and more requests. So if you're interested in becoming a professional in this space, you would like to host your own Multifamily Masters meetup in your local region, reach out to us. We will make it happen. There is an interview process because demand has been very high, but our goal is to get to 200 meetups before sometime this summer. I don't have an exact date for it. I think we can accomplish it. I'm 100% sure we can accomplish it. We have an awesome team of people behind us, and I'm super proud of what we are creating. We have a large Facebook group. Hopefully someone will put that Facebook group in the comments below. Share it to the comments below. Make sure you join that Facebook group.
Yep,
Our goal is to create or add as much value, as much content as possible. We have a monthly newsletter. And of course we have this, and this is the first one, our first Multifamily Masters online meetup. Our goal is to touch people kind of 3 times a month. We have the chapters across the US. That's awesome. We understand that's a little bit tough for a lot of people to get babysitters, to get off of work, to do what you have to do to attend your local meetup. So with that being said, we're going to do a monthly one, and we're going to add as much value and content as possible. What sets us apart? Our reach is huge due to our large scale in our meetups. Every day we get people asking to start new chapters in different cities, and I'm super happy and super proud about that. This group is spearheaded by 3 individuals with over 30 years real estate experience who currently own or control around 3,000 apartments. And what's really cool about that is this is not a one-man show. This is 3 people with 3 ideas, 3 different game plans. Even though we're all looking to collect more apartments, more cash flow, we all come from different angles and we can add a lot of different value from different perspectives. The 3 of us met speaking across the country several times. We've sat next to each other on stages where we've been speaking in front of 600 plus people. Just yesterday and the day before, Pal and myself were in Los Angeles speaking at a conference. 608 people were in that room. Really, all we did was add as much value as possible. Super happy about the weekend. Ferris wasn't able to make that meeting. That's the first one that he's missed. I missed him at that meeting, but he was at another conference doing what he does. And what does he do? He adds value. He adds content. The guy knows real estate inside and out. So now I'm going to introduce my 2 partners a little bit, and that's Mr. Pal Chi and Mr. Ferris Musa. So Pal, go ahead and take it, my man.
Yeah, for sure. So we'll get into a real quick set of intros. You know, I just wanted to give you a little bit of background of kind of who we are so that you kind of have some name to the face and things like that. But I've been doing real estate for about 4 years, but really multifamily real estate for about 3 years. So I bought my first multifamily property in January of 2017. So exactly 3 years ago. And since then, I purchased, I think, a total of, been involved in 7 different transactions. Yeah, 7 different transactions, all part of the general partnerships, all totaled over 1,000 units at this time. And so that's primarily where I am. How about you, Ferris? How about you?
All right. Hello, everyone. Thank you all for coming on. I guess for those of you that don't know me, my name is Ferris Musa. I guess my background's actually software. So I know there's a lot of engineers and computer people in this space. I think we just naturally gravitate to it. So I'm definitely one of those people. Kind of for me, you have a computer science degree, worked at Microsoft, and then got into real estate and love it. And so currently I'm a partner at Disrupt Equity. So me and Ben Stubbles, for those of you that don't know, we're the main two people that kind of run Disrupt Equity, and behind us we have our team. And currently we're at about 1,500 units that we, full assets under management. And, we're continuing to grow, right? We are becoming more and more vertically integrated, and kind of excited to see what 2020 goes. But, more importantly, I mean, we're excited to be here, help. I think for us, we're always happy to hop on and answer questions. And by us, I mean me, Garrison, and pals, right? The more value we can add, that naturally leads to relationships, partnerships. And, I've met countless partners through these kind of endeavors, right? And real estate is definitely a team sport, and I think that's what I love about it. So excited to kind of, meet new people and help continue to grow.
My name is Garrison Gilbert. 19 years experience. I've done absolutely nothing but real estate since 2001. Finished college, couldn't find a job. I did what any smart 21-year-old guy would do. I bought a house in the hood, fixed it up with my two hands, and kept going with it. I grew that into 1,200 houses. Sounds awesome? Not so much. Ridiculously unmanageable. Fast forward 2006, 2007, I lost $17 million. Then I realized, cash flow is the name of the game. That's kind of what propelled me into the multifamily industry. Before that, I did 1,200 single-family residences, bought approximately 400 non-performing real estate notes all across the U.S. I did beach houses up and down the East Coast, high-end fix and flips. Real estate-wise, you name it, I've probably been there, done that. I'm a little bit different than these guys. These guys buy 1, 2, 300 unit apartment buildings. I'm into that. That's awesome. But I'm also not scared to buy a 5, 10, 15 unit. Right now we are constructing and renovating a 74 unit office space. So I'm pretty diverse in real estate. I'm here to add as much value as possible. Hopefully you guys know me at least a little bit from social media. Pretty much in general, Multifamily Masters, let's rock and roll. I'm here to help you guys. I'm here to grow. I'm here to build teams. I'm here to network. Let's go. Let's grow.
Awesome. Awesome. So, hey, we're going to go ahead and we're going to get started a little bit and just talk about where we got started. But before we do that, we just wanted to make sure that you guys know the format of this is that we're really going to take the bulk of this first Multifamily Masters live event to do Q&A. All right. So we want your questions. So if you would start putting them in the chat, start asking questions, whatever, we're going to basically try to answer as many questions as we can kind of get to. We do have a 60-minute time limit. So we're going to end at 7 o'clock Pacific, 10 o'clock Eastern. Okay. So get your questions in early. Start to write them in right now. I know, we actually had a couple people ask a few questions earlier, but we'll be getting into that really quickly here soon. So go ahead and ask the questions in the chat.
And feel free to ask anything. I mean, really, this is here for you, right? From most people's meetups, right? I think the most valuable part at any meetup, whether it's online or in person, is the Q&A, right? Everyone has a different story. Everyone has a different nugget to share. So, there's not a dumb question, and feel free to ask what you guys want. So then I think,
sure.
With that said, I think the very first question, we'll go ahead and kick it off. But I think it's just, first one, we'll each probably answer this. But, if you were getting started today, what would you do first, right?
Well, hey, Ferris, I thought we were going to do the how we got started.
Oh, you're right. Okay, you're right.
But you can go ahead. You can start with your first one.
All right, I'll say for me. So
you do your
I'll
first
go ahead
one.
and answer that.
Yeah.
No,
and then
so
Garrison,
for me,
you do yours, I'll do mine after that. Yeah.
No, for me, I got started almost accidentally, right? I had extra capital I was looking to deploy, learned about real estate investing off of Bigger Pockets and a bunch of podcasts, read a lot of books, and then just kind of hopped in. And before I moved back to Houston, so for those of you who don't know, I'm based in Houston. But before I moved back to Houston, I had 4plex under contract, bought that, got a taste of multifamily. But for those of you that don't know Houston very well, there's not a lot of good 4plexes in Houston, right? Land is so cheap. There's a lot of houses. So I bought a bunch of houses and, got to the point where I just realized it doesn't scale very well, right? There are you know, 12 different loans, 12 different insurance policies, and, you know, it becomes a big headache. So got into multifamily and loved it, and, you know, in syndication as well, and just realized it's a mix of the two things I like, which is really people and numbers, and kind of the third piece is processes and components. So maybe that's, you know, a little bit of how I got into it, and kind of the rest is history from there.
I got into apartment buildings, and I'm located in Baltimore, Maryland. I got into apartment buildings where I lived in China for a year. That was 2012, and I brought a lot of capital home from China. And at that time, I was doing a lot of high-end fix and flips, multi-million-dollar projects. The level of detail was here, and my contractors were horrible. I lost a lot. I shouldn't say I lost a lot of money. I didn't make as much money as I hoped. And for lack of inventory in that space and in the smaller fix and flip space, my business partners kept telling me to buy apartment buildings, buy apartment buildings, buy apartment buildings. I was so against it. I had some horror stories when it comes to tenants in the single family space. And the last thing I wanted was a portfolio of tenants. But long story short, we bought a couple of 5-unit buildings, ended up buying a bunch of 20, 30-unit buildings next door to that. Now I have a portfolio of 200 or so apartments right around Hopkins University in Baltimore, and have 400 apartments spread throughout other regions in the country. Go ahead, Pal.
Awesome, man. Okay, so I'm Powell Chi, and I live here in Los Angeles, but all of my investing is done out of state. So I don't do anything inside of California. All my stuff is out of state. And so when I got started, you know, I started with a single family, but then I quickly moved from one single family to an apartment building. It was a 40-unit apartment building in Indianapolis. And like I said, that I mentioned before, that was in January of 2017. So my first multifamily was a 40-unit. I really did it by myself, so that I didn't have any partners at the time. My idea was, hey, I'm going to get into this multifamily business, but I don't want to take on any partners or any other person's money, because if I'm going to prove it, I got to prove it to myself a little first before I can start to ask anybody else if they want to partner with me. And so that's what I did. I did that, and from there, you know, have just continued to try to scale up, get more partners, get more people involved, and look at other markets. So although I'm in Indianapolis right now, I'm also in several other markets across the United States. There are probably Phoenix, Atlanta, Dallas, San Antonio, Jacksonville. So I'm pretty market agnostic. I just try to choose markets that are on the larger side. But for me, getting started was that first 40-unit building that I did by myself. And after that, it's really kind of partnering with everybody else. So why don't we...
So then I guess, yeah, let's go ahead and start going through questions. So the first one, you know, let's just kick it off with the first one that we had elsewhere, which is just kind of, if you were getting started today, right, what's the first thing that you would do differently? So Pal, you want to answer this one first and get it going?
You know, if I was to start today and, you know, like think about like what I want to do differently, you know, I think I would have vetted my property managers a little bit better. I mean, really, that's sort of a struggle that I've had, and that with my early ones, is that really that you need to make sure you're vetting your property managers pretty well. So you want to make sure that you're taking, not only are you vetting them up front and doing, you know, taking down, I would say referrals and, you know, going over your contracts and making sure that you're very comfortable with what they're going to do, but get into the reporting side of it. What reports are they going to give you? How often you're going to speak to them? What type of expectations you're going to have with them? But then what I feel is that you also want to have a backup, and you want to have somebody that's on the backside of it, that if it doesn't really work out, that you really can kind of, you've already sort of vetted that other person as well. So initially, I think that's what I would do a little bit different if I was to start over on my first one today.
For myself, if I was going to start right now in multifamily or real estate in general, for the first 15 years of my career, I honestly thought that I could do this alone. I did not realize the team aspect of this. In the last 3 years or so, I've really tried to build out my teams and build out my network and be more social. I could not have been less social for the first 15 years. I hid behind the veil of Intellivest.com. If you call me up, I don't want to meet you for lunch. I don't want to hang out with you. I want to sell you some property. Let's make some money and move on. Since then, last 3 years, I've tried to build my team and really build my network. And my goodness, if I would have started this 15 years ago, I would be on fire and I'd probably be sitting on an island somewhere versus this Zoom call at the moment. But that's what I would change.
All right. And then maybe myself too. It's just, I mean, it's kind of the same point as Garrison, right? Luckily me, I did partner on early on, but really kind of taking that and pushing it, right? Not being scared of, I remember one case where we had 2 deals going on and a third deal showed up that we just had to pass on because we were just too scared, right? I mean, we had too many going on, but now just knowing, hey, there, it's a big ecosystem. There's a lot of ways to partner. And, if it's a true deal, don't pass up on it. And coincidentally, that deal is actually here in Orlando, which is where I'm at right now. Cool. So then let's just keep going on. So next question, specific for Powell, how did you start, how did you jump straight into multifamily versus single family 3 years ago? So I know you mentioned earlier, Powell, but maybe you kind of briefly recap.
Yeah, sure. So, I started with single family, I started with one house, and then it took me about a year of learning, a year of analyzing deals, a year of going through a lot of analysis, kissing a lot of frogs, talking to a lot of brokers, and figuring out really on the sort of the underwriting side that I was comfortable enough to figure out where and what a good property would look like. So it did take me a year to get through to my next property, which was that 40 unit in Indianapolis. And that was kind of what I was doing up until then. So it was a lot of underwriting, a lot of calling brokers, a lot of analysis, and trying to put together my, what would be my team at that point. But really it was a lot of that upfront, just grinding through a lot of things that I think a lot of people can probably relate to that. You have to grind a lot, and it takes you a while to get your first one.
All right. Next question is from Aaron. Do you have any experience with water, Scrooge, I think he meant savings products, and what type of percentage saving can you expect from low flowing units? Maybe I'll take that one. So for those of you that don't know, right, the debt that we usually like to do is called, it's agency debt. Agency really means, think of it as government-backed Fannie Freddie products. And, yes, we do bridge debt as well. I know we all do it, but kind of the most beautiful of it is agency debt. It's the best debt that you can possibly get. Usually you're going in, 70, 80% leverage, 30-year amortization, 10 years, 12-year notes, and, 1 to 7 years IO. And so with that, Fannie for the longest time had a product that's kind of going away right now called the Green Program. And so essentially, if you're doing what we typically do, which is a value-add product, you can actually ask for the Green Program, which would give you a better interest rate, and they would actually give you that money as part of your rehab to do the work. And then last but not least, usually you can get more leverage because you're, if essentially what they're doing is they're modeling what your expenses are post-Green Program. And so fundamentally, the Green Program is exactly what it sounds like, right? You are improving the green efficiencies of an apartment, and it usually boils down to low water savings and electric savings. And so for us, we've done the Green Program on probably 3 of our properties, and yes, I think 3 of them. And there are savings. I mean, they are substantial. It varies by property, so I don't think it's really can give you an exact answer, right? But imagine, 10 to 20%. I've seen a deal where literally the water dropped, I think, 40%. And so, if you have a big water problem on a property, it could really fix the issue. But, the thing to keep in mind is that it is valuable, and that does boost your NOI, right? And you're getting more leverage. So, it's almost a no-brainer. The complexity, though, and the reason why this is going away is that for Fannie, it became a hard problem to maintain, right? And so there was kind of requirements around what you had to do, and then, did that actually result in the savings? And so it's not going to be as available. But as an owner, right, if I had an older property that didn't have any water savings, this is absolutely must do, right? One thing we do a lot, actually, we'll take over a property, we'll walk every unit, we will, go through and see if there's any leaks anywhere, go replace all of the toilet flaps, all of the seals. And then on top of that, if there's an opportunity to implement low flow, I mean, it pays for itself. It's not expensive, and it's actually a win-win situation. So I'll leave it at that. Do you guys have anything else to add? If not, I'll move on. Next question from Jathan. As a newbie, if you can learn how to find and analyze deals, is that considered valuable?
If you're good at it,
Garrison, go for it.
Now, I was just going to say, if you're good at it and you can become good at it and numbers is your thing, anything you can do to add value to other people and build your network and build your circle and build your team, that's awesome. A lot of people are afraid of the numbers. If you can excel at that, go for it. You can add a lot of value to other people, and it can be very, very, very valuable.
Mm-hmm. And I would just add to that, it's not necessarily always the analysis and getting in the numbers, but you need to be able to find the deals and then analyze them too. Right? That's the big part of it too. So, because a lot of people can have spreadsheets and things like that they can plug in. So it's not really the analysis. You need to find it, analyze it, bring it to somebody who can help you close it. So.
Yeah, and I guess maybe I'll add two things to that. Analyze doesn't just mean, hey, here's a number and you send it off. It means you've actually gone through the exercise. You've deduced that this is a good deal, and you're giving a prospective partner the breakdown, right? We have a lot of people that are just forward deals to us, and unfortunately, that's not that valuable, right? Deals are all, and by a deal, right, just to kind of, for those of you that newer, a deal does not mean a deal, right? Really, a deal means a property for sale. So we use that word very loosely. But being able to take a property for sale and determine that it's a deal is the real value, right? Not just forwarding along an email to someone like any of the three of us, and now we have to go do that homework, right? We already have our processes and systems, and that just doesn't really help as much. So really digging in and figuring that out. And the other thing I was going to add too is a big part of this business is relationships with brokers, right? And so finding a deal could be that, you're the one shaking the trees and getting kind of that deal flow, and maybe you hand that off to someone else to help with an analysis, but there are kind of two parts to that. All right, next question, Stacy. I'm looking to meet partners. What is the best way to determine if the prospective partners are the right fit for you? What have your experiences been?
I could jump into that one a little bit. So, I'll just give an example of what my business partner and how him and I have kind of gravitated towards each other. So, my business partner, his name is Juan Yang. And we met through this meetup. So I was holding my meetup and he came to me and he started talking to me about what he's doing. It turns out we were both investing in Indianapolis, right? And so then we started, okay, cool. He's investing in Indianapolis. He's looking at like 10 to 20 units. I'm looking at like 40 units or so. And then he started to do some analysis and on certain properties that he was finding. And then he would actually send that analysis to me and asked me what I thought about the analysis. And I was like, well, this is pretty open of him to just send me his analysis and tell me what deals he's actually looking at, trying to put an LOI in on. Most people are, want to keep that close to the vest of where they're actually investing in. So, but he kept doing that to me. And then, I kept sending him back what he'd want, what my opinions were on the property. And then we actually started bidding as a competitor to each other on certain properties. And then we started figuring out, well, why don't we just work together? We understand each other's underwriting. We like each other. So eventually we just became partners. So to make that quick story, as a quick story, is that he started offering me a lot of value and was very open about it. And wasn't trying to hide anything. And so to me, I was like, this guy sounds like a good guy to partner with. So we ended up being partners. That's how we grew up.
And maybe another thing to add to that too is, right, there's kind of, in this business, there's really maybe three kinds of partnerships, right? There's one partnership, which is an exclusive partnership. So me and my partner, right, we have an exclusive partnership, meaning we partner together on everything, right? And kind of what you look for in that kind of partnership is very different than others. And so, I've had a couple different businesses throughout my career, and you start to identify things that make a really good partner, right? And maybe for me, what I've learned is the most important one is find someone that has the same work ethic, right? I can literally call my partner Ben right now and we'll talk for 2 hours. And, we're both, we're on the same frequency. We're talking to each other 10 times a day, right? We have that same work ethic. The second really important one is the same long-term goal, right? Both of us are happy to essentially put all the money back that we're making back into the business to grow it because our goal is, a much, much bigger goal, right? And so make sure you're aligned with your partners in terms of what your long-term goals are, as well as what your work ethic is. And then maybe, to kind of just go quickly mention the other two, right? Non-exclusive, really, people partner with people based on the deal and based on how each person's adding value. And then you kind of have the middle of the ground, right? Where sometimes it's the same people, sometimes it's not. All right, we'll move on from that question. So next question from Jason again. One market I'm interested in is Houston. Do you think Houston is a good market for multifamily? I'll take that one since I'm based in Houston, unless Garrison and Powell want to add something. I guess what I would say about Houston, so for us, we own 0 properties in Houston, right? We have properties in Atlanta. We have properties in Beaumont, Texas, which is just east of Houston, San Antonio. We don't own anything in Houston. The question is why, right? Well, the reason we left Houston 2 years ago and went to Atlanta was because we were able to, in Atlanta, find a strong growing market, which Houston is, that had properties for sale at the right price point. And that's the important thing, right? Because, fundamentally, we are looking for cash flow. And if I can buy the property that cash flows a certain amount for $60,000 a door in Atlanta, right? Whereas that same property, that same cash flow might sell for $80,000 a door in Houston, obviously the Atlanta one's a lot more attractive. And so Houston's kind of a weird city because back in the 80s and 90s, for those of you that don't know, oil fell, right? We had Houston had a little mini recession. Nothing got built in the 80s and 90s. And so essentially you have this overbuild of A-class properties in Houston, and you have a lot of C properties that are essentially lipstick on a pig 3 times over that pretend like they're Bs, right? And so if you want to get into Houston, you're essentially going to have to probably pay up for a C. You're paying more than you probably should because it's pretending like it's a B, or you go into the A's. And so for us, it just didn't make sense. There just wasn't enough value add on the deals. And on top of that, they just weren't the right price point to get the returns that we want for our investors. And so Houston itself is a great market. I think it's just a struggle to find the right deals. And so for us, our strategy for Houston is going to be new construction. So that's something we're kicking off kind of this summer in terms of, we can build not A-class properties, but really fill that B-class gap where we can build the properties brand new for $80,000 to $90,000 a door. All right, next question. Hunter says, I want to buy a fourplex with an FHA loan and house hack the first year, then move back in with my parents and rent out all 4 units. I guess that's a statement. That's not a question.
Does that get you in on your first deal? I'm like, go for it. That's what I feel like.
Yeah, there's nothing wrong with house hacking. You have the leverage FHA loan. Use what you have, right? If you're in the Army and you can get, the Army loans, those are fantastic too. So there's a lot of, search for house hacking online. There's a lot of strategies if you're looking for that, right? And so it's a good way to maybe build a base, but there's also nothing wrong with jumping to bigger properties, right? There's a lot of reason, and it's possible to do it, if you have a team together.
And to touch on that a little bit, a lot of people get caught up in the whole multifamily space with, I need to buy a 100-unit deal. I need to buy a 100-unit deal. Our goal is for you to take action. Our goal is for you to get your first door. Our goal is for you to obtain cash flow. This is not a race. I love the idea of house hacking. I don't care if it's a 2-unit, a 3-unit, or a 4-unit. You do what works for you, what works for your goals, what works for your family. And as long as it's a win, keep on going and keep pushing it, my man.
Exactly right. All right. Next question. Pal, you're popular. Pal, did you self-fund that first deal? Do you still have it?
Yeah, self-funded, still have it. So, just kind of, buy with my own cash.
All right. Next question from Jathan again. When doing deals with partners, is syndication the only way, or is there other ways to do deals with partners without syndication? Is it a good idea to have a property management company on your team before? Actually, that's a different question. So, okay, let's pause there. So when doing deals with partners, is syndication the only way, or is there another way to do them? And so maybe I'll take this one. So for those of you that don't know, what is syndication, right? So if you think about, if I had $50,000 to go invest, right, today, that means I can buy essentially roughly about $200,000 of real estate if I'm leveraged, right? Now, the problem with that is that what does that get me? That gets me a house in Houston, right? But now if me, Garrison, Powell, and 10 of our friends all have $50,000, right, how much do we have now? Well, now we have collectively $600,000, right? If you're leveraged, that $600,000 gets you into a $3 million property, right? So we were able to pool together all of our resources, all of our down payment to go buy a much bigger, better asset. And what makes it bigger and better? Well, it really is just economies of scale, right? We can have full-time staff, we can pick the markets we're in, and we can do probably a different kind of value add play where we can force the NOI and appreciation than we might be able to with a house. And so that's what syndication is. Now, with syndication, there's a lot of things you have to kind of know what you're doing in terms of the SEC, following SEC laws and things like that, right? That's one common way, but that's not the only way. I know many guys that literally own 2,000, 3,000, 4,000 units alone, right? They do it just themselves, all their own money. That's another way. a different way as well is what's called a JV, right? So in a syndication, usually it's like an LP GP structure, which means you have kind of the LPs, which is limited partners, which are your investors. You have the GPs, which is the general partners, right? The people that are putting together and managing it. Well, with the JV structure, imagine you basically have everyone equal. So maybe me, Pal, and Garrison each put in, $1 million, and now we have $3 million of equity to go buy a, $9 million asset. And so that's more of a JV structure. And so you could really structuring is its own big, interesting thing, right? A lot of times you can make any deal work if you can structure it appropriately. But that's just kind of maybe the most common three, I'll say. Garrison, Pal, did you guys have anything to add to that?
No.
Nah, you covered it.
All right. Next question from the same person is it a good idea to have a property management company on your team before speaking with a broker?
Not necessary.
Pal?
Not necessary.
Yeah, exactly. It's not necessary. I mean, you want the property manager to help you kind of point out what areas you should go to or not. Like, we had a property manager that literally would tell us, if you bought this deal, I will not manage it. That's how much they don't like it. I want that kind of property manager. So, but that's, they're very different roles.
One thing I like to do with my property managers is I like to build relationships with several property managers in any certain region that we're looking to invest in. And a lot of times I'll build that relationship with the hopes that they're going to manage my properties, because I want them to introduce me to the brokers. If they can introduce me to the brokers then start calling me versus me chasing down brokers, which makes life a little bit easier.
Yeah. All right. Next question from Austin. How do you all feel about becoming an LP in a syndication as a good entry point to learning how to be a syndicator? I'll answer this one. So I actually think that's probably the best way. I mean, I personally did that, right? So for me, my goal is to be the best syndicator I can be. Well, how do I do that? I have to know what else everyone else is doing. So I invested with several people, and kind of you see the good, the bad, and the ugly, and you can make sure you do the good and avoid the bad. And so I tell people, I've had several people that approach me saying, hey, I have, $1 million I want to put into your next deal. And I tell them, first, divide it up across deals so you're reducing risk, but also try different people, right? Different syndicators have different appetites of risk. Some of them can perform, some of them don't. And as a person that wants to be a syndicator, you learn a lot really being an LP. How did that syndicator present the deal, right? What were the markets they were looking in, and what did they like about the deal? How did they do things like their PPMs and all of the paperwork, right? Were you comfortable in that process, right? Did you feel comfortable wiring them your chunk of money, right? Because honestly, you have to realize most people never wire more than $10,000 to anyone, right? Besides the house that they're buying. So for people that are wiring in $50,000, $100,000, $150,000, chunks of money, well, for them, that's probably the only time they're ever doing that. And so as a syndicator, you have to realize that and make sure that you show, that you're buttoned up, and everyone knows that as well. So as an LP, you're learning a lot by doing, becoming an LP, right? And then you see, how is that syndicator doing their monthly reports? How are they performing on the deal itself? How are they doing their distributions, right? And so for us, like Disrupt Equity, we actually have a 2020 goal, which is to really white glove our LP experience end to end. And so, that's just something to kind of keep in mind. But as a syndicator, you learn a lot just seeing what other people are doing. So I highly recommend that. It's the easiest way to at least get started and start to just become comfortable with the terminology and what's going on and all the moving pieces.
Yep. I was going to say, just for me, like if you already have what I've told a couple people this, if you already have a good financial engine that is basically giving you a good amount of income, and you can use that to then invest in as an LP and get into syndication. And that's probably what I think may be the better way to go about it if you've already got a good financial engine going, right? But if you are trying to be a syndicator and you want to syndicate this, that is another business. That is another financial engine. So if you're creating another business. So if you don't want to create a whole nother business because you're already got a good job or you already got a good business, then you're just adding a lot to your plate to try to become a syndicator right away. So sometimes I think it's honestly a little bit better to, if you've already got a good, like I said, financial engine that's going pretty well, you've got either a good job or a good business that's bringing you a good amount of money. Honestly, I think why add trying to be a syndicator on top of it, or try to, I would think that being an LP would be at that point be a lot better.
Yeah, and to reiterate just one quick thing, and then we'll move on. you know, to Pal's point, I mean, being a syndicator, you have to know how to run a multi-million-dollar business because these properties are multi-million-dollar businesses. So you got to be comfortable doing that and know what you're doing because you're also dealing with other people's money. So we'll kind of maybe move on from that because I know there's a ton of questions coming up. So next question from Ariel, how do we build broker relationships when you're a newbie? Garrison, you want that one, Garrison?
Yeah, go ahead, pal.
No, I mean, I was just going to say, because Garrison, I don't know how much you enjoy doing broker stuff, but I know for me, you know, I do broker stuff for far away. So like I'm looking in, you know, Kansas City right now. So you have to take the broker relationship very serious. So that means you have to, when you get something from them, like you ask them for something, right? You're trying to build a relationship. You ask them, can you show me your deal, right? They're going to say, okay, sure. Okay, you sound like a person I could buy this. Here's a deal that I could show you. Now we're going to show you a deal, but you need to take that exercise very serious. So you need to analyze that deal very fast, very quick, and get back to them within 24 hours and tell them what you'd like or don't like about that deal. And tell them with some numbers to back it up. I don't like it because the NOI is this, cap rate is this, what are my calculations for the income or the expenses are this. It doesn't seem like it's going to work for me, but let's talk about what else you have. What other properties do you have that are in the million to 1.5 million range or whatever else whatever your range is at that time. So honestly, when it comes down to taking brokers' relationship very serious, which means getting back to them right away. You don't want to have them send you something and then you don't talk to them because you don't like the deal. That's just not the way to go.
You know, something that stresses what Pal just talked about is I want to reply to every broker and every deal that they send me because I want them to see the name Garrison Gilbert pop across their email address or their email inbox, I should say, because I want them to know that when I call them about a deal that I've taken it seriously and whether I've looked at it, dug deep into it, or just kind of did a big aerial view of it. I want them to know that I'm serious about this business because next time some off-market deal pops up, I want them to think of my name and reach out to me because they know I'm serious about it.
Now, and to Garrison's point, be front and center, right? So the broker relationship is key to getting growth in this business. That's why I'm here in Orlando right now at NMHC because I'm going to meet all the brokers I know tomorrow and the next day, right? Take notes on all your brokers, know how many kids they have, know what they're up to, what they're doing, follow up with them every few weeks. And, you know, to Garrison's point, respond immediately. I mean, always give them feedback. Don't ever blow them off because they got 20 other guys they can go talk to. Why would they waste their time with you? So let's keep going. So, the question basically boils down to how is a stress test conducted on properties?
Repeat that, Ferris. I didn't
basically, whenever how do you stress test a deal, right? That's what it's asking. So maybe I'll take this one. So stress testing a deal, you want to look at, hey, if the market takes a dip, what are where's the deal going to position, right? You look at what does occupancy look like. So if you drop occupancy, maybe the market's at 95% occupied. You're, physical, and you're basically saying, okay, what happens if we fall to 85%? What happens if we buy the deal, we don't get the rent pops that we want, and we fall to 85% occupancy? What happens if we fall to 80%, right? You're basically just looking at, many factors, and, really all the things you can edit in the sheet are all the factors you want to play with and figure out, how many things have to go wrong till you're underwater, right? And then, from that, you can figure out, okay, maybe I'm going into leverage. I should probably go in 70% instead of 80%. I mean, there's a deal that we bought. We bought at 65% leverage intentionally just to reduce risk. All right, we'll keep going because there's like 15 other questions. What % of your total investment portfolio do you have in real estate and why? Let's each answer that one really quickly. 10 seconds, go. Pal.
I would say the majority. I don't know what percent. A lot. I still have a day job, so I do have like 401k that I put into, but it doesn't have that much money. I don't know. So I would say it's a high percent. It's probably like 80%, I would say. It's real estate.
Garrison.
For me, it's 75 to 80%. The only reason it's not 100 is because I'm invested into a couple other businesses that are big time cash flowing businesses, and that's where I take capital and put into multifamily.
Yeah. And then for me, I'd say probably 70%. I freaking love real estate. There's not a better long-term investment than real estate, so that's why. All right. How do you know who to invest your money with amongst all the deals that may come through your inbox? That's a fantastic question. Anyone want to answer that? I can answer that. Then, all right, I would just say, get to know the sponsor, know their track record, how many deals have they done in full cycle, who are they partnered with, right? I mean, and understand that deal too, right? Different sponsors operate differently. Different people have different business strategies and different appetites of risk. Does that deal match what you're looking for in a deal, right? As a sponsor, I actually try to match equity to deals. And what I mean by that is if I have a friend that I know that is very, not bullish on the idea, they think real estate is totally not a good thing, I'm not going to go put them in a deal that's not going to cash flow for 2 years, right? I'm going to put them in a deal that's going to cash flow quickly. So as an investor, make sure it matches, that business plan matches what you're looking for. And then on top of that, that the sponsor can deliver and perform. And so, this is where talking to people like me, Garrison, Powell, and everyone else on this call, you can kind of understand which sponsors are able to perform, which ones aren't, and which ones are newer and which ones aren't. There's nothing wrong with being new, but it's just, again, as an investor, it's something you want to be kind of aware of. Next question. He meant to say water Scrooge, not savings. Okay, I was wrong. So earlier someone had said water Scrooge. It's a company that specializes in tamper-resistant low-flow kits with a per-unit cost of around $45. I've never heard of that. Garrison, Powell, have you guys heard of water Scrooge?
I have not heard of water Scrooge.
Never heard of it. I have a mechanical engineer that goes everywhere with me on our properties, and whatever he says, we do.
So the takeaway is always bring a mechanical engineer with you everywhere you go. Thanks, Garrison. All right, next question. How do you find your deals? From Raj. Powell, you go first.
Mine is primarily through brokers, right? Through broker relationships. So that's primarily where I'm finding my deals.
I have slacked in the broker relationship category throughout the last couple of years because my opinion is the market is tough. I've gone directly to seller, direct marketing, direct mail, cold calling, things of that sort.
Yeah, and for us, broker relationships. To Garrison's point, if you're looking at something less than 50 units, the direct stuff works more easily. Something kind of 80, 90, 100 and up, really it all goes through brokers one way or another. It might be not marketed widely, but still a broker. Next question.
Just to add to that quickly too, a lot of people are, when you're considering investing out of your area, like out of state, like I do, direct marketing and things like that, I found it was going to be a little bit more difficult because you need to be there right away. So if they tell you, yes, come look at my property, you're talking to the seller and for an 18 unit, you need to go visit them right there and tomorrow. So if you're flying in, you got to figure, this causes a lot of headache if you're not really in that market. So it can be a little more difficult to do direct marketing if you're not in that market.
No, that's a good point. All right, next question. In your opinion, what are the best markets for multifamily? To be more specific, where the cash flow is strong and returns are great. Those are the markets we all look for. Fundamentally, you're looking for markets that are safe because of job growth, population growth, but at the same time, you want to find the right price points. And so that's not to say that secondary, tertiary markets aren't good, right? Because again, those also are attractive because usually you're getting more cash flow. So it's kind of a balance between risk and cash flow. So for us, we like Atlanta, we like Florida, we like Texas. We don't like Dallas because it's too expensive. We don't like Houston because it's too expensive. We also like secondary and tertiary markets. We're doing a deal right now in Corpus, and we had 3 deals in Beaumont, Texas, of all places, which, we sold 2 of them for home runs. And so, there's a deal to be had anywhere if there's growth. And so that's maybe I'll leave it at that. Next question.
Let's try to do some fire round. We got about, I guess.
Yeah, I'm trying to do a fire round now. So
we got 5 minutes. We only got 5 minutes. Yeah. So let's fire around these.
All right, I work in W-2 that has high demand on my presence, so my target market is my backyard, which also happens to be a very hot market. When I get sent properties that have great opportunities, but the price is not realistic, should I send an LOI at a price that makes sense? Yes, but it gets to a point where, you send LOI so the broker sees you doing stuff, but if you're not even close on these deals, you might have to reconsider and go to a new market. Okay, next question. I own a 62 unit. With my team, owner pays water. Do you have any recommendations for metering the water? Yeah, there are companies that will help meter. I don't know what you're looking for exactly, just the recognition of the company that can help. Turning properties that are all bills paid to not all bills paid is definitely a good value add if you could play it right and it's the right market. But yeah, Scott, if you have any more questions, feel free to reach out directly. Next question from Rodney. For buying a small multifamily property, 2 to 4 units, any thoughts or experiences with using a bridge loan or HML, hard money lender, for the down payment? Garrison, that's you.
If the numbers work, go for it. I don't know if I'd necessarily go with a bridge, but hard money all day long. I've borrowed millions and millions and millions of dollars at 14.9%, 3-point. I know it's a lot cheaper than that. If the numbers work, do what you got to do.
Yeah, this is such a risk is the biggest thing, right? And, you know, what happens if the market tanks, make sure you're not going to be upside down. Next question. I'd like to talk to someone about the FHA housing hacking goal. I didn't finish my original question, which was the house turning into an investment for property tax benefits. Would this be the day I moved out or when I refinanced the property to conventional? Which was the house turning into? The house turns into an investment the day you move out, I think is what the answer to that question is, right? But yeah, Hunter, it sounds like a more complex question. Just send us an email. We're happy to help try to get you answered then. Next question from Jonathan. If you can find and analyze deals but don't have the money, is it still possible to do a deal? Who wants to answer that one? All right, I'll answer that one. The answer is yes.
Part of it.
There's a lot of ways to get into a deal. There's a lot of ways to partner. Finding a deal, analyzing a deal are definitely some of those. It's not just about having money. Next question. What are the important factors that what I wanted to know? Sorry, Sarit, I think this was tied to a question you asked earlier, which I'm not finding right now. If you could just type out the whole question, we'll take a look at it again. Could you partner with someone who has the money or maybe wholesale the deal for a fee?
Garrison's done that. Garrison? Can
Absolutely,
you wholesale a deal?
Do it all the time. I used to own one of the biggest wholesale companies in the Baltimore, D.C. area doing single-family, smaller multifamily. Last year, I wholesaled a deal out, 77-unit Atlanta. I put 100 grand in my pocket for doing 23 hours worth of work. Definitely possible.
Yeah. What's nice about real estate is there's a million ways to make money in real estate. There really is, right? Just kind of being creative and doing what you're comfortable with.
Get creative.
All right, next question. When analyzing a deal, what are the important factors that you consider, like cap rate, et cetera? So I guess there's two sides to this, right? As a passive investor, right, what do you want to look for? You want to look for what is the property currently doing? What is the business plan? And what is the syndicator putting in for year one in terms of how they expect to go? But if the syndicator is expecting to do a 30% pop in income in year one and there's no down units or anything like that, it's probably not going to happen, right? And, you know, so you want to really see where the deal is and what the year one looks like in year two. Does that match the business plan? Second, the big question you want to look at yourself is what are your rent escalators and your expense escalators, right? Kind of industry norm is you really want to be 2 to 3% on the income and, you know, 2% on the expense. Sometimes you see guys that put 10% rent escalators. Don't ask me why. Probably not going to happen, right? Most markets are, you know, 2 to 4% on the good markets in terms of rent growth. Next thing you want to see is really what is that exit cap. So the exit cap just means what cap rate are they modeling the exit, whatever their time to exit deal is in terms of what the market is. So, you know, you want to see today, if it's a fixed cap market, you assume you model that the market's going to get worse than it is today, not better. So you want to see that, you know, increasing. And yeah, I mean, those are the main ones. And the other ones, all this kind of occupancy, right? What is their occupancy in terms of the market? Next question. How do you feel? And we're going to go for another. Sorry, go ahead, Garrison.
5 minutes to go.
Yeah, I was going to say, 2 more questions and we'll wrap it up. Next question. How do you feel about areas with low population growth, plus or minus 1%, but have job growth greater than 2 to 3%? I'll answer this one. I mean, it's all about your business plan if you're comfortable with it. So, I mean, those are fine, right, as long as there's growth. I don't like markets that are falling, personally, in terms of growth. But if there's population growth and, you know, even if it's small, that's fine. And guess what? If you have job growth, that means probably your rents are actually going to increase quicker than anything else. And then last but not least of questions, what are the main factors you consider in a stress test? I think Sarita, we answered that one earlier, right? So you want to look at, you know, what is the occupancy of the property, both the economic and physical. You want to look at what are your rents, what are the market rents, and kind of how are you comparing, and what is your rent pops, and, you know, what happens if cap rates get worse than what you're expecting. So fundamentally, the biggest thing we look for is make sure how bad does a deal have to get before we can't even service the note, right? That's maybe the question we're all trying to answer. So with that said, we'll stop right there. Garrison, you want to wrap us up?
Absolutely. Call to action. In the comments below, we have a Facebook group. definitely join that Facebook group. If any of your questions did not get answered here, we will answer it in the group. We will answer every question in that group. Our goal is to create the largest content-driven Facebook group in the world. Number 2, next month, third Monday of the month, third Monday of every month, we're going to do this. It might not be as Q&A driven. It may be. We're not sure. We're working with this, and we're going to figure this out as we grow. But
and we'll bring guest speakers too.
Yeah, and we're definitely going to bring in some big hitters and some big guest speakers. So it's not just the 3 of us every time. We have an awesome team of people behind us. Our goal is to grow with you. And number 3, if you are interested in hosting a meetup, if you're interested in becoming a professional in this space, in your market, reach out to us. We will have 150 plus meetups across the United States before mid to late summertime. Reach out.
Everybody. Well, thanks everybody. We're going to close up shop, but we will talk to you all soon. See you on Facebook.
Thank you so much for attending.
Thank you all.
Appreciate you giving us our time.
Everybody.